everyone. It's a couple minutes before 10, so I'm just going to wait a few minutes while people are coming in. Good to see everybody. We had a great event last week, last Wednesday night. Many of you were there with David McKnight. David McKnight joined us live, and I thought it was a really fun event. And I know I was reading the feedback cards. A lot of you folks found it very informative and motivating, and that's really great. So it's always good to see, even clients who have been with me for a long time pick up something new. And that's really interesting. And that's why sometimes you'll see repetition on these webinars. And you've heard me say it before, and I'll say it again because it's repetition. But these things, they're complex strategies, complex thoughts, and different than what you've probably been taught in the past. So we have to kind of rewire 40 years of sometimes 40 years of conditioning when it comes to how you should invest your money. And we're seeing it right now in the markets, in the investments. The overwhelming majority of people think that as you get older, you should put more money into bonds because they're safer, and that'll be the safe alternative to stock. And we're seeing bonds down just as much as stocks right now in this certain ones. I'm speaking very generally in this market that we're in. So, and taxes are another thing. We were taught for years and years and years to contribute to tax deferred vehicles, and your taxes, your income needs will be less in the future when you're retired, and your taxes will be less in the future. Now, I'm sure that's true for some people, but in the 21 years that I've been doing this, and the type of people I work with, who have significant assets, that's just not the case in my experience. So it is a rewiring. It's a different way of thinking about things, and I think it's important. And I give you all so much credit for accepting that. Those of you who do, and those of you who are on this webinar are certainly part of that group, because when it all comes to a head, and there's just no time to fix it, and that's unfortunately how Congress is going to act. Then you're going to be in good shape. You should be in good shape, and unfortunately, others are not. But my goal, as is to just inform as many people as possible to try to get them out of the way of this tax train that we're talking about, on top of everything else. And I'm going to dialogue a little bit here because, that's not the word, dialogue, but I'm going to talk about this. But we always talk about federal taxes, and that is a big concern, right? The doubling in the next 10 or 12 years of the federal tax rates. And I shared with you, we've got a study group within the Slott group, and every year we look at it, the average middle-class American is going to be in the 40 to 45% effective tax rate, not marginal tax rate, but effective tax rate in the next 10 to 12 years. So that's staggering. So to be in a 45% effective tax rate, the top, the average marginal tax rate has to be in the 60s. So that's reality, and that's the math. But it's not just federal tax. So in Pennsylvania, I was actually listening to a podcast David McKnight did yesterday. I can't remember where I was driving from, but he was talking about someone that he had a case that was brought to him by someone he works with in an advisor he works with in California. And I think they were talking about the state tax, and they were calculating the state tax on this Roth conversion, and it was at 11 some percent. So that's something here in Pennsylvania, and for the most part in New Jersey, that we don't have to, or it's manageable in New Jersey, that we don't have to deal with, right? We have this pension-friendly state. We still have a very low income tax rate in Pennsylvania, 3.07%. And it's pension friendly. So what does pension friendly mean? It means that any pensions you receive and any qualified IRA distributions, including Roth conversions, are not taxed at the state level. So that's a real gift. Now I'm here to tell you that's going to go away at some point. And I really want you to believe me on that, because when I was standing in front of classes several years ago, I said, we have this thing called the stretch IRA that isn't really an official term, but it's something that we use in our planning that is at some point going to go away. When that goes away, things are going to become more difficult and more challenging when it comes to required minimum distributions for heirs of IRAs. And here we are with that. We're going to talk about RMDs today, and RMDs have become more complex, and they're going to continue to get more complex. So, I think the federal government, the legislature, tried to simplify it, and every time they do that, it seems to make things more challenging. So what I believe is, as I said, I think that pension friendly situation is going to go away in Pennsylvania. So not only are you going to have to worry about your federal tax, but your state tax, no matter where you live, because every state that I know of, maybe you can point to one or two, I'm not sure, has a pension problem, it has a budget problem. Certainly we do in Pennsylvania. So in my 8 years that I served on the school board for Council Rock, you might remember me telling you my first year, our contribution to the state pension was about $5 million. And my last year, it was 37 million. And you might think, well, over 8 years, that doesn't seem so bad. I think it is. But that 5 million to 37 million changed, and most of that in about 3 years. So that's because we have a pension problem, and they're trying desperately to catch up to it. So plan on state tax going away. And then the other thing is your local tax. Well, unless something significantly changes the way we have structured public schools in this country, and certainly in Pennsylvania, state tax, your local taxes are going to continue to increase, and not just school tax, but local tax. So these are, if you can take care of the eliminating the tax on your IRA distributions and make them Roth IRA distributions and tax efficient distributions, then that's something you have to focus on, not just for the federal tax, but just all the way down. So I hope you enjoyed the event last Wednesday. I hope you took away, I know many of you are motivated because my calendar, boom, filled up very, very quickly. So that's exciting. I get to have a lot of exciting conversations and try to help people out. And the food was great. Joe Garvey, if you ever need an event, Chef Joe Garvey is fantastic. I think his food is exceptional. I love those crab cakes he does, and that filet crostini. Oh my goodness, so good. But it was a fun night. It was nice. It was nice that David was there to speak, because I got a chance to sit in the back of the theater and listen to him and kind of watch the reaction from the crowd and eat a little bit. So that's always good. So good to see you all. It looks like everybody's here. So let's get started. All right. So we talked a bit about David McKnight. I want to thank David if you're listening. I think sometimes he does jump on because he says some things that sometimes, or maybe watches the videos. But I want to thank him. Really great event. I can't wait to have him here again. We chatted for a bit after, and then in the subsequent days, and he really enjoyed the folks. He really enjoyed the venue. I was always optimistic about the venue, but I think the Newtown Theater, but I think it turned out fantastic. So upcoming, we have Changing World of Retirement Planning webinars. So these are the classes that many of you have attended live or via webinar, and we've got 2 coming up in May and June. Now, because these are coming up and the way they're structured, I haven't had a special webinar since Sarah Brenner, and I think that was in March. So I don't know if I'm going to be able to squeeze in a special webinar. I'd love to get another one of the either Ian or Andy joining us specifically to talk about RMDs. Today, we're going to talk about some required minimum distribution RMD strategies, but I'd like to spend an hour with them just talking about it, because again, they become so complex, and the planning around RMDs is so important. But we have these webinars coming up starting May 12th and May 17th. So a Thursday and a Tuesday. And the first series is going to be 2 3-hour classes. So the 12th and the Tuesday, the 12th, and then the following Tuesday. And then starting on the 17th, I'm sorry, that's Thursday, goodness, the 12th and the 19th and the 17th. And what would that be? The 24th. So that's one series. You'll get invitations like you always do. Many of you would have asked me about this. When you get your invitation, feel free to share it with your friends and family or people you think would benefit. These are webinars. We can host as many people as we, we have a capacity of 500, right? And so we usually get, 50 to 100, depending on the turnout. We do send workbooks, so it's not really unlimited, but feel free to share it. The workbooks aren't that expensive. And then we have back to back, we start another webinar series June 9th and June 14th. Now, this is going to be 3 2-hour classes. I'm really interested. I want to see what works best. That's why I'm doing it back to back like this. 3 hours is a long time, but adding another night is a challenge sometimes, especially going into the summertime, but it should be okay. So keep an eye out for those emails. You're going to be getting those invitations. I better get that 5/12 out soon. Writing myself a note. Sorry. Okay. So as I said, today we're going to talk about requirement and distribution strategies and considerations. Just one headline I want to talk about. So I saw when I was going through some of the material this morning is that the Fed Chairman Powell has made some comments about returning rates closer to normal. And there was an article about, well, what does that mean? Normal, neutral. So returning rates closer to neutral. So neutral should be about 5 or 6%. I'm going to share with you where we are today, but that's about right. That feels about right to me. So the average 10-year treasury should be at about 5.5%. And it's, it's been very, very low. And even today, it's still very, very low. Still lots of uncertainty around Ukraine and Russia. Unfortunately, it's really not getting the headlines, but it's terrible what's going on over there. Inflation is always in the topic. So our last report was 8.5%. Many people are, some analysts are talking about over 9% when we get another report. So that's troubling. I went and filled up my Jeep on yesterday or Sunday, and it was $75. That's not, I was talking to a friend of mine, and he's got 12 large pickup trucks in his in his construction company, and he spends thousands and thousands of dollars a week in gas, and it's making it difficult for him, and it's making it difficult for everybody. He's got to pass those costs on to his customers, of course. So I'm going to jump into the Ed Slott updates. So this is where I read and share with you some of the reports that come in that Ed publishes, and his analysts publish once a week, and or throughout the week, I should say. I kind of gather them. And then there's also this mailbag where people write in and ask questions. I always find that, very entertaining and kind of fun. So let me share my screen with you, because Kathy had suggested, and I think it's a good suggestion, that I share this screen with you when I'm reading these, because it's a little easier to follow. So what you're seeing is my notes here. There's no client information or anything like that. This is just my notes that I do to prepare for these webinars. So this is from Ian Berger. So Ian's been on our webinars before, and he's talking about the Secure Act 2.0. So the Securing a Strong Retirement Act, or the Secure Act, was passed, I guess it was 2019. Yes, it says it right there. But this is some additional changes to that and additions that Congress is talking about. So a bill designed to increase savings in IRAs and company plans has passed the House of Representatives. And this is important. It's not law yet. This could and is likely to change. But let's talk about some of the key points within this, because a lot of people are talking about this, and many people think it's already law, and that's not the case. We just won't know until it's done. So the bill is officially called the Securing a Strong Retirement Act of 2022, but many are calling it Secure Act 2.0 or Secure 2.0. Since it's seen as an expansion of the original Secure Act from 2019. So on March 29th, the House of Representatives passed the bill by a near unanimous 414-5 vote. So obviously that's outrageous today, right? Really great bipartisan support. The action now moves to the Senate, where several committees are working on their own retirement bills. So if a consensus comes out of the Senate, it'll have to be reconciled with the House bill before it goes to the president. All this may take some time, but here are some important pieces. Let me just pull up these bullet points. There would be a gradual increase in the age. This is causing a lot of confusion. There will be a gradual increase in the age that traditional IRA required minimum distributions must start. Currently, the first RMD year is age 72. The bill would delay the first RMD year to age 73, starting in 2023, 74 in 2030, big jump there, and 75 in 2033. You would be subject to the age 73 RMD age if you're born on or after January 1st, 1951 and before January 1st, 1957. So that's causing some confusion, but it would right in 2023, we would go from 72 to 73. And then really we don't have to worry about anything until 2030, where it jumps again until 74. If I were in Congress and writing this, I would just want to jump it right to 75. Now, Congress doesn't want to do that because RMDs create what? They create distributions, which in turn create tax, because many people will hold their funds in their traditional IRAs until they pass, and there are no, if they passed at 74, then they never took a distribution. Congress, the IRS never saw that tax, and now depending on the structure, if they pass before their required beginning date, the government may have to wait another 10 years to get that money, and they don't want to do that. So simplicity would be, let's just make it 75 and evaluate it, as we go, but they want to make it a little more complicated because they want their money. All right, catch-up plans. Some of you will be able to make higher catch-up contributions to your company plan or IRA beginning in 2024. For plans, retirement plans, remember retirement plans and IRAs have different rules. You can't treat them the same. So for plans, retirement plans, the current catch-up limit for those age 50 or older is $6,500. That limit would increase to $10,000, not an addition, but but only if you're age 62. So I'm over 50, but I'm not yet 62. So I'm stuck, right? I would still be governed by this 6,500. So 10,000 if you're age 62, 63, and 64. For IRAs, the current catch-up limit is frozen at 1,000. The bill would allow that limit to increase based on the cost of living. So that's good to have that cost of living increase in there. Any catch-up contributions to plans for those age 50 would have to be made as Roth contributions starting in 2023. This is a really important point. I'm going to change my pointer here just so it might be easier to follow me. So people ask about, well, what about this Roth? Are they going to do away with the Roth at some point? You'll see, and it is common. And I talked about it last week. Jeffrey Levine had talked about it in his Horse's Mouth article. Congress continues to push us towards the Roth IRA. Why is that? Because they want their money now. They're not long-term planners like we are. They don't think about what's going to happen in the future. They just want to fund this beast now. So you'd have to put those catch-up contributions in a Roth. In addition, as soon as the bill becomes law, your employer could allow you to have employer matching contributions made as Roth contributions. That is huge. So in anybody's 401k plan, mine included, any company matches have to go into the traditional tax deferred bucket. You can make your contributions if you have them into the Roth, but any of the company contributions have to go into the traditional tax deferred bucket. But under this law, it would allow the contributions to be Roth contributions. So that's really, really great. The limit on qualified charitable distributions, which are tax-free direct transfers from traditional IRAs to charities, would also be indexed for inflation as soon as the bill becomes law. That limit is currently $100,000 per person per year. We're going to talk about that in our RMD strategies today. We've talked about QCDs, or qualified charitable distributions, quite a bit. This is becoming a tool that is being used more and more and more every year. Starting in 2024, I'm writing myself a note for this. our discussion today. Something that just popped up in my head. Starting in 2024, employers with more than 10 employees, hold on just one second, with more than 10 employees who establish a new 401k or 403b plan would have to provide automatic enrollment. This means that employees would be forced to contribute to their plan unless they opt out. So if they just don't do anything, they're going to have to contribute to the plan, or they can say, I don't want to be involved. Employers would be allowed to make matching contributions to company savings plans and simple IRAs on student loan payments beginning next year. The Savers Credit, a federal tax credit for mid and low income taxpayers who contribute to an IRA company plan, would be expanded, but not until 2027. As soon as the bill becomes law, there would be a new exception to the 10% early distribution penalty for IRA and plan withdrawals for victims of domestic abuse. So that's important. So again, it's not law yet, but these are some of the highlights of the bill. All right, let's go into the mailbag. Here are the questions. So this is an example of questions we get about RMDs all the time. So let's look at what Bob says. Bob says, I'm 68 years old. I would like to start IRA withdrawals. What are the rules for withdrawing before my RMDs are required at age 72? So you folks probably know this. What are the rules? Well, there really aren't any rules, right? So whatever you take out, you have to pay tax on. That's really the only rule. You have a window between 59 and a half and age 72 currently where you can do whatever you want with your IRA. Prior to 59 and a half, if you take it out, barring any allowable reasons, you pay an early withdrawal penalty, right? 10% plus the tax. After age 72, at this point, they tell you what you must take out. You can always take over that amount, but what you must take out. So you have this window where, it's really your money. You can do what you want with it, except for the part that the IRS owns that you got to send them. So Bob, there are no limitations. This is from, who did I say this was? Andy. Andy writes, Bob, there are no limitations to withdrawing your IRA before the RMDs begin. As a 68-year-old, you have full access to your IRA whenever you want it, penalty-free. Assuming all the dollars in your IRA are pre-tax, it's a good point, Andy. Some people do have after-tax dollars in their IRAs. That's true. See it all the time. People send us rollover checks and they'll have a rollover of $2 million in a traditional IRA, and then they'll have, $200,000 after tax and maybe a portion Roth. So that is not uncommon. This also assumes your IRA isn't invested in something where liquidity might be an issue. As long as you are aware of the tax implications of an IRA withdrawal and the possibility that the increased income could impact other items like IRMA, income-related monthly adjustment amounts that has to do with Medicare and the additional amount you have to pay for some Medicare portions if you earn over a certain amount of money, or if your modified adjusted gross income triggers this IRMA charge. Like IRMA surcharges in a couple of years, that means it has a 2-year look back. Then your assets are available for you to use as you wish. However, before making any quick decisions, it might be a good idea to speak with a financial advisor. Always a good idea to speak with a financial advisor or a qualified CPA, the financial advisor should be a qualified financial advisor. It should be a certified financial planner, and it should, when you're talking about IRA withdrawals, be someone who's involved in the Slott Elite Advisor Group. So here's one from Eddie. Does the 10-year rule apply to IRAs with charity as a beneficiary? Another great question. So if we leave money to a beneficiary via, a charity via IRA beneficiary, do they have to draw it all at the end of the 10 years? Good question. Andy writes, charities do not get the 10-year rule. As non-designated beneficiaries under the Secure Act, they would instead, depending on the age of the IRA owner at death, need to be paid out over either the 5-year rule or the remaining life expectancy of the deceased IRA owner. However, if a charity is named as beneficiary of an IRA, the most likely occurrence is that the charity will request a lump sum distribution as soon as possible. If there are co-beneficiaries named on the account, as long as the charity beneficiaries paid their portion of the IRA before September 30th of the year after the year of death, the 10-year rule would then apply to the remaining IRA beneficiaries, or possibly the stretch of their eligible designated beneficiaries. So that got a little complicated at the end, and I'll share with you how to avoid that. But charities aren't going to wait 10 years, 5 years, and they certainly don't want to stretch it out. They want to take that lump sum distribution and use it for their their charitable endeavors, because there's no tax involved. There's no reason to manipulate this. When Andy's talking about if there are other beneficiaries involved, an easy way to do this is if you have for instance, if you have $3 million in your IRA and you determine that $1 million of this I'm not going to need in my lifetime, and I'm going to name a beneficiary, XYZ qualified beneficiary or qualified charity as beneficiary, just separate that out as a separate IRA, and then you don't run into these problems. If you try to get, kind of, the word cute is coming up, but if you try to get tricky with it and say, okay, I want to keep all the $3 million together, and I'm going to name my son and my daughter as primary, or 33 and a third, 33 and a third, and then name the charity as a 33 and a third, then it gets more complicated. It's just not worth it in that way, because think about it, if you designate it as a charitable, the charity as a beneficiary, and you find out you need that money, you just change the beneficiary, or you can still draw the money out. It's not like you're putting it into a trust. In fact, you don't have to change the beneficiary to draw it out, but if you change your mind and want to change a beneficiary, you can. That's a really simple way to get things done, is just, if you're charitably inclined, naming a charity as a beneficiary to your IRA, if you can fully fund your lifestyle, can make a lot of sense. All right, that's it for the Ed Slott report. I'm going to stop my share. Hello again. I didn't ask if everybody could see that, but just raise your hand, like push the raise hand button if you could see that. So, hey, Jerry. Okay. Thank you, everyone. All right, so let's talk about the markets. I am going to share my screen again. I want to share this chart with you. So this is the chart I review every week. I've lost my there it is. I've lost my share. Sometimes this thing moves around. I don't know where it is. All right, so here's the chart I reference every week when we're talking, and I just want to share it with you this time. So this is Invesco. This is an investment firm. I have no relationship with Invesco. They are just a provider of ours. I like the layout of their market reports, and I also like the fact that they're timely. So they come out on Monday. I've used others in the past that have similar information. Sometimes they're just late, and I can kind of count on Invesco. So I like from a reporting point of view. This is nothing to do with their investments, although we have used them in the past. But and I guess currently we may still have a fund, but that doesn't matter. There's no relationship with Invesco. It's just a source of information. Certainly not a recommendation to use them either. So let's take a look here. So the Dow Jones Industrial Average, right? So these are the big stock indices right here. Dow Jones Industrial Average, the S&P 500, and NASDAQ. So that's really, really well represented of the major companies in the U.S. So you can see, and they do return a little bit differently. You'll see the Dow Jones Industrial Average was down last week. So this ends April 29th, of down 2.47 for the week. It's a big move. So far year to date, 8.73, and we've gone negative year over year. So this was a huge positive number for almost the entirety of the pandemic coming out of the initial drop. But this has turned negative year over year. The S&P 500 was very close. It was down 3.26. Instead of circling, I'm just going to leave it there. Down 12.92%. Let's just call it 13 for the year. And the NASDAQ down almost 4%, down 21% for the year. So this is what we're dealing with right now. So this isn't to concern you. This is to raise awareness. Pay attention to what's going on in your portfolio. So that is basically the U.S. stocks. You can see the MSCI World, which is good representation of stocks around the world, not including the U.S., down 2.2% for the week, almost 11% for the year. Emerging markets, you'll see, is up slightly last week, but down for the year. Europe, Asia, and the Far East here down 2.17, down almost 12% for the year. So nothing looks great here all across the globe, right? So you might expect that, but what most people are experiencing and we're not expecting is this fixed income means bonds. So this is, again, what I've been talking about for a long time, and it seems like nearly forever. This is this one here, the Barclays Aggregate Bond Index, is probably the best representation of the U.S. bond market, and where most people have their bonds invested is tracked by this here. So I'm being very general, just trying to give you an idea. So that was down 0.02% last week. That may not seem like a lot, but almost 10%, 9.5% for the year. So the short-term bonds, 1 to 3 years, a little bit positive last week, still down 3% for the year. So this is where people are getting really concerned, because they think, okay, well, I'm going to put my money into bonds. You know, they may use that rule of thumb. I'm 60, I should have 60% in bonds, or they're following a 60-40 portfolio, and the entire thing is down. So this is the time when I start getting emails from friends and family. Can you take a look at my portfolio? You know, suddenly it's down. And, you know, I do these things as a favor if you're not a client, if I can squeeze it in. But this is also the danger of those target date funds, because the target date funds automatically go more conservative, right? Which is more to bonds. And I was air quoting. I hope you saw that because I'm sharing. Bonds aren't necessarily more conservative. So they automatically ratchet to a higher bond holding, but you'll see you can still lose significant amounts of money. I think negative 10% is a significant drop. So how do you manage that? What should you be doing? Well, of course, those 3 pillars of investing, I'm always talking about asset allocation, right? Now, this is an example where asset allocation alone doesn't save you, because your bonds are down, your stocks are down. Stocks are pretty much down across the board. Yes, there are some that are positive, but the way people invest today using these indices, right? Using these things, the Dow Jones Industrial Average, the SP 500, the NASDAQ, most people invest in mutual funds or ETFs, exchange traded funds, and they're just down across the board. And then they have their bonds and they're down. So asset allocation isn't doing it right now. You need those other 2 pillars. Principal protection, that's helping, right? When you can't go below 0, we have maturities coming up where the return for the last 12 months has been 0. That, folks, is better than negative 8%, right? Because often we take a portion of the bond portfolio, we put it in principal protection, and the worst that can be done is 0 in a year, and that is 0 is much better than 8.42% down. That's my official CFP position on that. The other part of it is account segmentation, where we identify how much money you're going to need for each time in your life and carve out a portfolio that is set there. Now, I'll tell you that our first segment portfolios on average are down about 2%. So that we're experiencing some down, but on that money that you need today, and we're holding actually right now much more cash, but our average is about 32%. We're holding about 60% right now in cash, and we'll hold that for a while until we can implement some strategies that are going to help protect our clients during that time. But that's a big difference. So asset allocation, principal protection, and account segmentation are very, very important. All right, I'm going to stop sharing. No questions about that. I'm shocked. Okay. All right, let's continue with the market. So Mr. Jason Zweig from the Wall Street Journal just wrote a little blurb. April went out with a whimper, not with a whimper, but with a bang. He says the shares in Amazon fell 14% on Friday. I hadn't even witnessed that on Friday until I read this article. That was their latest one day drop in more than 15 years. So if you love Amazon, it might be a good opportunity for you. U.S. stocks, that's not a recommendation. U.S. stocks overall fell 3% to 4% on Friday. A dismal finish, the worst April since 1970. The worst April since 1970. Folks, if you don't think we're in the middle of it right now, you're not paying attention. We have significantly outrageous inflation. A recession is, I was reading something from, the Wharton professor, Jeremy Siegel, earlier today or this week, I don't remember when, but he had some positions, but they were kind of maybe positions. So he really wasn't taking any position. He said he doesn't expect a recession to happen in 2022 or 23, but it may. Well, that's not really a strong analyst position. So we've got a recession around the corner at some point. We're dealing with this inflation. We don't know when that's going to happen, and the Fed has to. So let me go back up here and share with you. I missed this here, but let me share this this chart. I wanted to share the Fed funds, right? So remember, I was talking to you about the neutral position for the Fed, and that should be around 4 or 5% for the 10-year Treasury. So this is where we're at. We're at 2.93 right now. The prior week was 2.9. A year ago, we were at 1.63. At the end of the year, we were at 1.51. So we still have a lot of movement to make. So the Fed funds target rate right now is 0.5. It'll likely be increased to 1% this week, but the Fed's going to have to move aggressively, and that typically there's all of this market movement down is attributed to uncertainty. We don't know what it's going to look like. We don't know if the Fed really can affect this strong inflation numbers. We don't know if they can raise rates as quickly enough without really driving the market down. We don't know what's going to happen in Russia and Ukraine. We don't know what's going to happen in in Washington. So all this uncertainty just continues to swirl and will it continue to push the markets down, over the next, certainly this year, right? So I told you in the beginning of the year, I expect it to be slightly up or slightly down by the end of the year. Now we're down much more than I thought we would be. I never expected an 8.5% inflation rate, but we'll have to see what happens. Again, you got to pay attention to these things, and you got to take action. Okay. So moving on. U.S. stocks. This is Jason Zweig again. U.S. stocks overall fell 3 to 4% on Friday. Kathy Wood's ARK Innovation Fund ETF, no recommendations to buy or sell these positions, fell 34% in April, and even Apple lost 12% for the month. Bonds took a battering, he writes, off 3.8% for the month and 9.5% year to date. We just saw that. So I want to make sure I'm not sharing anymore. Okay. BlackRock, I'm just going to read to you what BlackRock says. I think they're way off base with this. So no wage price spiral, they say. So wages have been increasing, right? We lost a lot of jobs, a lot of workers for jobs. Wages have become significantly higher. There's in our building in Quakertown, there a staffing company rents one of the spaces, and I see $20 an hour for labor work, right? Like so they have a sign out there. So for road workers and just general labor, $20 an hour. Now that's not a commentary whether that's the right pay or not, but that's significant. And with those costs, employee, payroll costs, the costs get pushed out to the to customers. So they're saying we don't see a wage price spiral. Companies are actually paying less in labor per unit of output. We think wages can rise more without adding inflation. I don't see how that's the case. Market backdrop, they say the S&P 500 plunged to new 2022 lows last week. We remain overweight equity stocks, when they say equities, in this inflationary backdrop, but acknowledge mounting challenges. So they didn't say a whole lot there other than they continue with their position. The Fed, so I think they're way off with wage price spiraling. And then they talk about the Fed. The Fed is set to raise its policy rate by 0.5% this week in an attempt to rein in inflation. We think the eventual sum total of rate hikes will be historically low. I also think they're way off for that. I think the Fed's going to have to be much more aggressive than what they are anticipating. Okay, so let's talk about MFS. So MFS is another investment firm, and they write this I forget what they call it actually, but it's just interesting information. So they talked about the 10-year treasury, and the 10-year treasury note was cut in half during the first year of the pandemic, falling from 1.91% to 12 on 12/31/2019 to 0.91% on 12/31/2020. So they cut that in half. That's that 10-year treasury I shared with you. Since that time, it's doubled again, right? So in the first 16 weeks of 2022, as the yield on the 10-year treasury note has nearly doubled, rising from 1.5% to 2.9%. So we saw it drop in half with the pandemic and then come back to where it was, and then through it to a doubling. The United States had this is what I'm talking about the workforce. The United States had 3.5, let's just call it million deaths. I'm sorry, this is the deaths. The United States had 3.5 million deaths in 2021, up from 3.38 million deaths in 2020, which was up from a pre-pandemic 2.855 million deaths in 2019. You know, that's just sad, isn't it? They're calling for in a 2020 study of the Lancet, which is a general medical journal, founded 199 years ago in 1823, predicted by the year 2100, the 4 largest populated countries in the world will be India, Nigeria, China, and the United States. Interesting. I found that interesting. Here's the information about the labor force. An estimated 3.4 million American workers dropped out of the U.S. labor force since early 2020, when the global pandemic began, and have chosen not to return. 3.4 million workers dropped out, not coming back. The difference between a projected 167.8 million workers that would have been in the labor force if the pandemic had not occurred versus 164.4 million workers actually in the labor force. So we're at about 3.4 million people who just have not come back. They said 41% of 1,168 American retirees surveyed in June 2021 were very concerned or somewhat concerned that the value of their retirement accounts might not keep pace with inflation. That was in June 2021. Imagine how they feel today, right? We weren't seeing crazy inflation yet. Widely followed Wall Street analyst Ed Yardeni predicted in early April 2022 that Europe has a 50% chance of suffering a recession in 2022, while the US has a 30% chance. So look out for the European markets as well. His response to high fuel costs, reversing a January 27th, 2021 executive action taken by President Biden that stopped the leasing of federal land for drilling purposes. The Biden administration last week restarted this leasing program on 144,000 acres of public land and across 9 different states. That's 225 square miles of land. Oil and gas producers will pay a royalty of 18.75% on the revenue generated from drilling, says the White House. So that was a big step that I know Biden wanted to take, was to stop the leasing of federal land, and then they reinstituted it to help with the cost of oil and gas. The number of existing homes for sale nationwide at the end of March 2022 was 950,000. The number of existing homes for sale at the end of March 2017 was 1.8 million. Ooh, big drop. The number of existing homes for sale at the end of March 2012 was 2.32 million. The number of existing homes for sale at the end of March 2007, was 3.81 million. Wow, that's a really big drop. Think about that, from 2007, 3.81 million to $950,000 last month. 950,000 homes, last month. Ooh, that's crazy. The average property taxes paid on a single family home in the United States in 2021 was $3,719, equal to 0.9% of the fair market value of the average home nationwide. Thought that was interesting too. We always, as I said in the beginning, we always focus on federal tax and sometimes state tax, but don't really talk about that local tax that'll continue to increase. All right, it's 10:42. Raise your hands here. Would you like me to continue and talk about RMDs, or would you like to carry that until next week, because we're going over time? Okay. I'm getting a raise hands. All right, so hang in there. I'm going to share my screen here. I'm going to flip to my whiteboard. And if you need to sign off, you can always view this. It'll be up in a couple days on the website. Let me share my screen here. Okay, you should see my whiteboard. Just raise your hand for me again if you can see my whiteboard. All right. So what I have here is financial planning topic, RMD considerations and strategies. I'm going to draw on here, so you're going to see me look down, just moving some of my things out of the way. All right, so this is the new uniform lifetime table. So let me share with you where you can find this. There's several new people on today. So I'm dragging down my website. So if you go to attleborowealth.com, you'll come to our landing page. And over here, I have a section called the Slott Corner. It's a lot of great information. And if you want to view our weekly webinars, special webinars, and live classes, you can view them here. But in the Slott Corner, if you click on that, you'll see information. There's a picture of me and Ed. There's a webinar we did together. Some information talking about the Slott program. And then you'll see these tables, and you can go in here as often as you like and view these tables. You can also download most of them. I did find today that so there's Medicare income planning. This is a very good one. This is your tax planning table. That's important. We talk about that a lot. Retirement plan contribution limits. Again, you can download that and keep it, or just refer to it here. Tax planning for investment income, health savings account chart, and then this uniform lifetime table. So we started this just began in 2022. This is a new table. We're going to be referring to this. And I noticed today when I went in here that they never set this up for download. So you're going to have to refer to it on the website. It's okay. It doesn't cost you anything to go to the website and refer to it. Then this is a great sheet. This is the Secure Act from 2019. And this is all about these crazy stretch, non-stretch 10-year rule, non-designated beneficiaries, non-eligible designated beneficiaries, eligible designated beneficiaries. So this is a great resource. Folks, I use that all the time. So access that as much as you like. That's at attleborowealth.com under the Slott Corner. Now let me get this out of our way. Moving this thing all over. All right, so we're going to talk about RMDs. So let's just remind ourselves here. RMDs start at age 72, and it's actually, you have a required beginning date, and that's April 1st of the year after the year you turn 72, right? So it's April 1st, not the tax filing deadline. People confuse this, right? Tax filing deadline, that is not the answer. So let's get tricky here. Put it, not that, but April 1st of the year following the year that you turn age 72. Most people take it in the year they turn 72. It makes things easier, but you do have until that date. Now, not long prior to the Secure Act, that was 70 and a half years old. But that doesn't apply today either. That applies to one thing we're going to talk about, but not to RMDs. So your freedom with your IRA is from 59 and a half to age 72. That's when you can do anything you want with your IRA. Prior to that, in most cases, you have a 10% penalty. And then after age 72, you must take your RMDs. If you don't take your RMDs, raise your hand if you think that the penalty is 10%. Nobody raised their hand. Good, because the penalty for not taking the RMDs is 50% of what you should have taken. That's the largest one on the books as far as I know. And how do we figure out what it is? So we go to your table here, and if I'm 72 this year and I have $1 million in my IRAs, right? Then this is your life expectancy. So we would take $1 million divided by 27.4, and that's where we get our number. For the first time, the IRS has given us this percentage. People had always talked about it as a percentage, but it's now listed on the table as a percentage. So we know then that this equals $36,500 that we must take as your required minimum distribution. And if you say, well, you know what, I don't need that. I have a pension, or I've got my Social Security that covers that. Well, too bad, you must take it. So you also may not think, well, this is not a bad deal, right? I'll take it. It's fine. $36,500. The problem, of course, is we know what the tax rates are today. What is going to be the tax when you're age 72? If you're not there already, we don't know. And interestingly enough, let's fast forward to age 82. So 10 years later, and this makes it easier using the percentage. So if you begin at 3.65%, and then 10 years later at age 72, you must take 5.41%. What happens to your RMD? Well, of course, it goes up. As your balance typically grows as well, your IRA balance, right? We have to look at, if I didn't mention, you look at the previous year balance. So 12/31, in this case, it would be 2021. If you turn 72 this year, that's what you would base it on. So hopefully your IRA grows over this period of time. And if it's $1.5 million at age 82 and you've been taking distribution, well, now it's going to be 5.41% of $1.5 million. So that equals more money that you have to take out, and still your I don't know tax rate. And it progresses. If you make it to age 90, you have to take out 8.2%. So the IRS clearly wants your money. So the question is, what are strategies to consider around this? Well, the first is, and let me just note one other issue. So if you have $1 million and you're at 72, you're still going to have growth. But what if you're 65 years old? What if you're 65 years old and you have $2 million in your IRAs? And now you know that you've got to take required minimum distributions at age 72. But what's going to happen to that $2 million? Well, hopefully it's going to grow. And if it just grows by 6% over that period of time, you will have $3,187,696. So now, of course, that's greater than 2 million. And the required minimum distribution on that is $116,340. Again, at the I don't know tax rate. So you just don't know. That should be a question mark. You just don't know what that tax rate is going to be, but is it likely to be higher at age 72 than it is today? And that answer is yes. So what can we do to handle this RMD concern that we have? Because we can't tell the IRS no. Well, the IRS has given us some tools, though, to handle this, and shame on us if we don't use them. So the first thing is plan. You have to plan for how these RMDs are going to come out and how they're going to affect you. So many people are surprised by them. Well, geez, now I'm 72 years old. I've got $2-3 million in my IRA, and I've got to take this massive amount of money. What do I do with it? And the government's going to take a significant portion of it. And if you're in a state with state tax on that, including probably Pennsylvania by that point, 8 to 10 years from now, you're going to pay state tax on it as well. So the first thing is plan. Of course, have that discussion. Don't get caught up in it. Don't get surprised by it. Know what to do. And then you can work on mitigation. The first mitigation that we'll do, right, or consider is Roth. Well, of course, you know that you've got, if you've got your buckets and you've got $2 million, let's use that 2 million over here. How much should you be moving to your Roth, and over what schedule? Because you may be able to leave $500,000 in here, and we'll talk about that. Many of you know this strategy already. Let me just make this a little easier. See, I'm trying to erase. It's not erasing. You may be able to leave $500,000 in here, but you might also have to transfer the whole thing. So with the plan, that's how you determine the schedule and what works best for you. So we're going to come back to that 500,000. Let me circle it. I know you've seen me do this a million times, but it doesn't hurt, right? So if you end up with $1.5 million over here, well, then guess what, folks? There are no RMDs for you during your lifetime from Roths. So not only are distributions tax-free, right? There's no 0% tax, there's no tax, but there's no RMDs. So that's good. So that's one way to control it, is the Roth conversion. Number 3, change my color, are distributions. Well, on top of the conversions and distributions, or on top of the conversions, you may want to take some distributions. If you have spending needs during retirement, and you know that this $2 million is going to grow to $3 to $4 million, and let's just say you have $1 million sitting over here as well, you might want to take some distributions out of here. It all depends. It goes back to the plan. You always have to go back to the plan, right? Everything cycles back to the plan. You may want to take distributions out of that IRA to help draw it down. So because sometimes these schedules are difficult with just Roth conversions. You can manage this bucket another way. I'm not going to get into that today, but distributions might make sense, because when you look at your marginal tax rates, 10, 12, 22, 24, 32, 35, 37, we certainly want to try to fill it from most people to the top of this 24. So maybe a portion of it is Roth IRAs, Roth conversions. Maybe a portion of this is distributions to help bring this down. Nothing wrong with that. So distributions could be part of it. The last thing to consider today is the qualified charitable distributions. We've talked about that a lot. We talked about it earlier today. That's $100,000 per person. This is where it's tricky with the IRS after age 70 and a half. Not the year you turn age 70 and a half, but after you turn 70 and a half. If you do it before that, you don't get it. And it must go direct to charity. So that could really help, because if you determine, and what's important is that let's use this example. So what do we have here? We have 1 million, 2 million. So if your buckets look like this, when you start, before you do any planning, you have $1 million in, I didn't label them. I'll label them here: taxable, tax deferred, and tax free. So if you start before your plan and you say, I got $1 million here, I got $2 million here, and then you do your segmentation, and you determine that if I start here, let's just say you retire in 2022, and again, the goal is you fund your life all the way till the time that you're no longer here. And if you determine through your segments that, we can go zero, these are common, what I put down as an example. So these are years, right? 0 to 3 years, 4 to 6 years, 7 to 9 years. And we're just going to go 10 plus years here for simplicity. But if you determine that this is your legacy and longevity section, and this is, if you determine that this is money, longevity, let's just say you end up with, let's call it $500,000 to be easy, $500,000 that you're likely never to need during your lifetime. It's there if you need it, right? But you're likely never to need it. And you've already taken, if you have kids, or other people who are close to you, and you said, okay, this is an amount of money I want to leave to them. And then you have this $500,000. Well, it may make sense if you're charitably inclined to leave it to charity. So this is where it gets really simple. I was talking to someone who attended either a class or the event last week, and they're talking about their wills and trusts and charitable contributions, and it's really complex. And I said, well, if you've got, and I think they had about $3 million in their IRA. If you got $3 million in your IRA and you know that you're going to leave X percent of your estate to charity, and if that's about $1 million as an example, why not just name that charity as beneficiary? You don't even have to deal with a trust. And then you have full control over it, because you can change a beneficiary at any time, can't you? The answer is yes, you can. But if you determine that you're not going to need this money likely during your lifetime, but so it's likely for legacy, but it can't be there for longevity, you could do a couple different things. You could, first of all, name a beneficiary, a charity as a beneficiary, right? Easy. You're no longer here. This grows. Maybe it's $2 million by the time you pass. that charity gets $2 million. Nobody ever pays tax on it. No reason to convert it. No reason to worry about it. That's going to go. Now, if you're worried about, and some people say this, well, wait a minute, Mark. You're telling me that I have to take required minimum distributions. This $500,000 is going to spin off, $100,000 or so, or $50,000 of required minimum distributions. I'm still going to have to pay tax on it. Actually, if you know that money is going to go to a charity, along the way, you don't have to wait to die, right? Along the way, you can do the charitable, qualified charitable distributions up to $100,000 per person if you're over age 70 and a half. So let's just say the required minimum distribution on this $500,000 is, let's round it up to $16,000. Well, you can send that right to a charity. And it doesn't have to, you can split it up and be multiple charities. It just has to be qualified. But again, you have to determine what's needed for you, and you've got to be charitably inclined. Some people, that's not their thing, and that's okay. This is just one tool. But if the markets get ahead of you, don't forget, it doesn't have to be $16,000. It can be $100,000. The risk of you doing a $100,000 charitable contribution during your lifetime on a $500,000 legacy longevity is that you might be giving up money that you may need at some point. So it is a balance, of course, and you always have to go back to the what? To the plan. Always have to go back to the plan so that everything cycles back to the plan. All right, so let's wrap this up with this other 500. This is a different, it could be the same, but this is that $500,000. So there is another way to take advantage of required minimum distributions. If you don't have any other income, that can mean that this $500,000 is tax-free. And this is, if this works, this is the perfect $500,000 for you, because you got a tax deduction, or you didn't pay tax on the payroll deduction going in, and you don't pay tax going out. So that simply requires a required minimum distribution. That is what happened there. Where'd it go? Required minimum distribution that is less than your standard deduction. So if you're a married couple, today, your standard deduction, I'm pulling up my trusty chart on my website. This is what I do all day long just to get it right, because it changes every year and my brain doesn't keep it that long. Today, your standard deduction is $25,900. That does adjust every year for inflation. So if your required minimum distribution, going back to that table again, there we go. 500,000 times 0.0365. That's 18,250. 250. My eraser's not working on this new whiteboard. Isn't 18,250 less than 25,900? Yes, the answer is yes. And if that's true, yes. Where's my, now it's not running at all. Well, the answer is yes. So if that's true, then zero tax is paid on that, with nothing's happening here. Come on, guys. So it's not writing, but the answer is, if the 18,000 here is, now it's a spot. I don't know how that happened. So Microsoft has a brand new whiteboard and I don't like it right now here today. But the 18,250 is less than the $25,900 standard deduction. Absent any other income that's going to affect that standard deduction, you would not pay tax on that required minimum distribution. So we want to be really careful about the amount that we're converting. So I hope that's helpful. I know it was quick. It's 11:02. I've kept you all too long. I'm looking forward to seeing you next Tuesday. For those of you who I'm going to see in the next week or so who attended the event last Wednesday, I'm looking forward to talking to you one-on-one. And have a great week, everybody. Take care.